Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about how to build a trading edge. Okay, so if you've been around the trading space or you've hung around traders who are kind of intermediate to professional traders, you must have heard this word thrown quite a few times. And that's because having an edge or crafting an edge that you're going to be using to trade within the financial markets is one of the bare essentials that you need to do in order to become a consistently profitable trader. Okay, and that's the reason why this is what we're going to be talking about in this week's episode. Okay, so first things first, what in the world is an edge? So put simply, an edge is just the set of rules or set of decisions that give you an unfair advantage over the market. So what do I mean by a set of rules or a set of whatever that gives you an unfair advantage over the markets? So it is assumed that when you're trading in the financial markets, you're speculating in the markets, you're actually making decisions for when to buy an instrument and when to sell it in order to make a profit. It doesn't, you're trying to buy it when it's priced low so that when it increases in value, you're going to cover your close your trading position and bank your profits. And if you're trading in something like the forex markets where you also have the ability to go short, you're actually selling whatever instrument you're trading with the hope of it going lower than the price where you sold at, so that in the future you're going to cover that short and then bank your profits. Okay, now we are not just doing that at random. What I mean is, you don't just open the charts and just click on buy and sell at random. Usually you're going to have a set of rules that are going to define when you're going to buy, when you're going to sell, how much you're going to risk on each trade you take. Okay, and then when you're going to take your profits, when you're going to take a loss, when a trade is obviously not going to continue moving in your favor, and all of those things. Now, the combination of all of the things which I just mentioned and a little more are what gives you that edge in the market. Okay, so for an example, an edge could be something like, for a trader, could be something like buying when there's a moving average crossover, and selling or closing that long position and reversing and going short when there's an opposite crossover. That could be that trader's edge. And so maybe with whenever that crossover happens, he decides how much to risk, which all of these things must have been tested and proven to work in the past. Okay, and even though past performance doesn't guarantee future results, it actually gives you, when you try something out, a trading methodology or a trading technique that has kind of worked in the past, then there's a high probability that it might continue working in the future. And so you're not just going in blind when you're trading the markets. Okay, so how do you build that edge? And that's what today's class is all about. Okay, how do you create that edge that gives you an unfair advantage in the market? Well, if there's one number, if there's one single number that is going to tell you, or that most traders, professional traders, will tell you to look at, okay, for you to define, for you to determine whether or not you have an unfair advantage over the markets, that number is going to be expectancy. So what exactly is expectancy? Put simply, there's a formula for expectancy. Okay, and I'm going to explain what it is in a little bit, but first I just want you to understand the logic behind it and how it all comes into how it influences your edge, how you define whether you have an edge in the markets or not based on your trading methodology or your trading approach. Okay, so the formula, your expectancy formula, which is E in this case, is equals to your average win. So I'm just going to make it easy for me to write it here. Average win will be AW, okay, times your average win rate percentage. Okay, so let's say your win rate, WR. Okay, then in bracket you now subtract your average loss, which is your AL, okay, times your loss rate percentage, which is LR in this case, for example. Okay, and so the resulting number you get here, let's say this is 0.5 for example, And we're going to look at practical examples, don't worry, okay? This is just to make it easy for you to understand. And let's say whatever the number we played with in this part of the equation is 0.2. Okay, now when you subtract 0.5 from 0.2, you're going to be left with 0.3. If this is the resulting number you get as your expectancy, and it's positive obviously in this case because you're subtracting 0.2 from 0.5, which is obviously bigger, in this case the resulting number you've got is plus 0.3. This would mean that you have a positive expectancy, and so whatever trading approach yielded this number is actually a positive expectancy system, and so it is likely to be profitable when you deploy it to the live markets. Okay, but if this number was negative, for example it was 0.2 minus 0.5 and you ended up having minus 0.3, that will tell you that what you're dealing with, the trading approach or the methodology you're dealing with, is a negative expectancy system, and so over the long run there's a high likelihood that that approach is going to end up losing you money. Okay, so now let's go out of the realm of the logic and whatever. Let's do it practically in a way that makes sense for you to understand. So let's say you have a trading strategy, our example trading strategy in this case. Let's say it has a 50% win rate, and the average win, the trading strategy is designed in such a way that we usually trade with a fixed risk to reward ratio. For example, whenever we trade with the strategy, okay, we risk 1% of our account's starting balance. And in this case, let's say we are dealing with a $100,000 account. So in this case, let's say whenever you take a trade, you're risking 1% to make 2%. So your average win will be 2 times what you're risking. So in this case, it's going to be $2,000, while your average loss, remember, you're risking 1% of your account starting balance on each trade you take. So your average loss, if price was to go on to hit your stop loss as you take the trade, let's say ignoring commissions and all of those trading costs, okay, let's just say your loss is fixed at $1,000 US. Now in this case, when you look at the numbers, our average win is 50%. Is $2,000. Okay, while our average loss is 1%, because the trading strategy has a fixed risk to reward ratio where whenever you take a trade, you are risking 1% of your account starting balance, which in this example is a $100,000 account, to make 2 times what you're risking. So you're aiming to make $2,000. So when you take a trade, when you place a trade using this trading strategy, it's either one of two things happen. It's either price goes on to hit your stop loss, which will cause you to lose $1,000, or it will go on to hit your profit target, which will make you earn a profit of $2,000. Okay, now the win rate of the trading strategy, hypothetically here, we said it's 50%. Now going back to our expectancy formula, remember I said it's going to be your average win, okay, which in this case is $2,000, minus your average loss. Okay, minus your average loss, which in this case, your average win times your win rate percentage, which in this case is going to be 0.5, because when you do 50% divided by 100%, you're going to get 0.5. You don't need to know how the calculation, the formulas work when you just use a tool like this, okay? It's just going to do everything for you. But I'm just reiterating this so that you know how it works underneath the hood, so that you get to understand how this number that we're talking about all comes about. Okay, so average loss is going to be $1,000 in this example, times your loss rate percentage, which in this case your loss rate is 50% too. Now in this particular example, we're assuming that we're considering a sample size of 100 trades. Okay, now in this case, because your average win is bigger than your average loss, and we're talking about like 100 trades in this sample size, your expectancy per trade, meaning how much you can expect, win or lose, regardless, win or lose, how much you can expect to make per trade, is $500. And that's because 2,000, do I need to bring up my calculator? I don't think I need to, but let me quickly just do the numbers, okay? So it's going to be 2,000 times 0.5, because it's 50%. Okay, so 2,000 times 0.5 minus 1,000 times 0.5, 1,000 times 0.5, and we arrived at this number, $500. That's our expectancy per trade in dollars. Okay, now What does this have to do with anything? This is telling you that, let's assume you took 100 trades, okay? Within those 100 trades, given the win rate of your trading strategy is 50%, obviously you're expected to lose 50% of the trades and win 50% of the trades. Okay, so you're going to lose 50 trades. Since this example is 100 trades, you're likely going to lose 150 trades and win 50 trades. But because whenever you take a loss, you're only losing $1,000, and whenever you take a win, you are winning double what you are risking on average, which in this case is $2,000. After all is said and done, when you subtract your gross loss from your gross profit, then you are likely going to end up with a profit of around $50,000. Okay, now this is what you would expect to make over those 100 trades. But for you to see whether your trading edge, your trading approach, if is even profitable to start with, then you need your expectancy number to be positive, and that's where that formula comes into play. Okay, that's what this tool does. It calculates everything and it shows you your expectancy for this particular trading system is $500 per trade. You can expect to make $500 per trade. Okay, and if you were to take 100 trades, since your expectancy is $500 per trade, you can expect to make something like $50,000. So this is telling you that you have a strong positive expectancy. You have an excellent edge if you're trading with a strategy that has these capabilities. So let's assume it's a mechanical trading strategy, and you know, when price makes a crossover, for example, that's what the strategy's rules is. When price makes a moving average crossover, you take the trade, you risk one to make two, and you know, you do the position sizing and you place the trade, and that's just the rule. It's as simple as that. Okay, the strategy should compound well over time. So with a 50% win rate and an average win of $2,000 and an average loss of $1,000, your expectancy is $500 per trade, totaling $50,000 over 100 trades. Now what if we were talking about taking something like 500 trades? You can expect to, assuming all things remain equal, you can expect to make even as way up as $250,000 with this particular trading edge, given that you're trading this account size, okay, in this example. Now, what about the opposite? Remember, the win rate of this particular hypothetical trading strategy is 50%. Let's go back to our 100 trade sample. Okay, now let's assume that instead of you making a profit of $2,000 whenever you win, and okay, before I even talk about that, let's quickly look at one number here. With this particular trading methodology, okay, this strategy that we used as an example that has a positive expectancy, you need to have a minimum win rate of 33.3% for you to break even, not even make money, so that you don't win money and you don't lose money. Okay, if your win rate is lower than 33%, even though your average win is 2,000, twice the size of your average loss, you lose money if your win rate is lower than this. And for you to see it practically, you see here our win rate is 50%, and that's why we have a positive expectancy. But what if our win rate was like 30%? In this case, you can see that the strategy will go from having a positive expectancy to now having a negative expectancy. Why? Because its win rate is now 30%. So let's say you take 100 trades. Because its win rate is 30%, you can only expect to win 30 trades and you'd lose something like 70 trades if you take like 100 trades. Now, because of this, whenever you win, even though you're winning 2 times what you're risking on average, because your win rate is so low, okay, it still doesn't give you a positive expectancy. You end up with, remember, when we had it at 50%, our expectancy was plus $500 per trade. But now that our win rate is very, very low, below the minimum we need to break even, you can see that we now have a negative expectancy, which is minus $100 per trade. So with this negative expectancy, the strategy is going to lose money over time. So you should not trade with this type of trading strategy live. Now, this brings up something that is very important in the trading space that I want to draw your attention to. You see, there are basically 2 camps of traders. One camp of traders will tell you that trading, when you're trading the markets, you need to have a trading strategy that has a positive risk to reward ratio, so that maybe if you're risking 1, you can aim to make like 2 or 3 or 5. In fact, some traders take it so insane that they'll tell you to have a trading strategy that risk like 1 to make 10 or 50 or whatever risk to reward ratio floats their boat. Okay, now in this case, yes, when you trade with a trading strategy that has a positive risk to reward ratio and you risk very little to make a lot, even if you lose a lot of trades, just winning one or two or a couple of trades here and there, because your wins are ginormous, you would end up being profitable. But what they fail to tell you about trading strategies like this is that most of the times, before you get those huge winners, you would need to exercise a very, 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 insane amount of discipline. Because let's say you're trading with the trading strategy that you're risking 1 to make 50. You are trading with a strategy that has a 1:50 risk to reward ratio, for example. Just imagine the emotions you would go about feeling when you place that trade and then the trade goes all the way to like 20 times what you're risking, and then it starts, because price doesn't move in a straight line. It moves up, it pulls back, it moves up, it pulls back, it moves up, it pulls back. So let's say it goes all the way to 20 times what you're risking. So if you're risking something like $1,000 on the trade, for example, it went all the way up to 20. You were up at some point $20,000, but then because price doesn't move in a straight line, it pulled back all the way down to you having a profit of like $5,000. Most traders, the discipline of most traders is not at a level where they're going to sit on their hands and say, you know what, I know that I'm trading with a 1:50 risk to reward ratio fixed. Whatever happens, even if it goes to 49,000 and comes back, I'm not going to close the trade unless it hits my profit target or hits my stop loss. With most traders, what is usually going to end up happening is when price goes a huge amount in profit and it starts pulling back, they're going to get scared and close the trade with a small profit, and eventually, when the losses are manifesting, they will take that loss fully. But then when those huge profitable trades come, they will not let them play out to their full potential, and so they will end up taking small profits, and then their losses are just going to keep piling. And that's one side of the spectrum. Then there's the other camp, the camp of traders who tell you that you can have a very, very high win rate. All you need to do is just have a negative risk to reward ratio. So if you're risking 1%, for example, aim to make a fraction of that, and then you're going to end up winning a lot of trades, but just one losing trade is going to set you back tremendously. Both of these camps, okay, are not right or wrong. It all depends on the trader's capacity and capability to actually remain disciplined. That's what I'm looking for. Because you could be a trader who doesn't care about having a couple of losses in a row. You could be that trader that you've backtested a trading strategy and you've seen that having a 10 losing trades in a row is normal with your strategy, and so you've accepted it and it doesn't really bother you, and so you can have 5, 6, 7, 10 losing trades in a row and you'd still remain disciplined and trade with your trading strategy, following its rules without breaking the rules of that strategy. In that case, then go with it. You might have, trade very well with that positive risk to reward ratio strategy where you're risking very small to make a lot, and that might work for you. But the other side of the equation is that you might be that trader who just 2 or 3 losing trades in a row starts to really get to you, and so in that case, trading with a strategy that has a negative risk to reward ratio might be the thing for you, because the negative risk to reward ratio trading strategies, most of the times they are going to give you a higher win rate even though the profits are little, but then you're not going to be exposed to those extended losing streaks of like 5, 6, 7 or even 10, 20 losing trades in a row, for example. Okay, and that's just an extreme example I'm giving here. So now let's show you practically how this would be if you were trading with a negative risk to reward ratio. For example, let's say you were trading with a trading strategy where when you win a trade, you make $1,000. But then when you lose a trade, okay, you only lose, because you're trading with a negative risk to reward ratio, in this case, you lose $2,000. Now, in this case, look at what this tool is telling us. It's telling us that for you to be able to just break even, not make money, just in such a way that you haven't made any money and you haven't lost any money, you need to have a win rate of 66.7% if this is how your trading strategy is designed. So it's designed so that every time you win a trade, you win half of what you're risking. And anytime you lose a trade, you lose, like 2 times what you're risking. Okay, so in this case, let's say you have a win rate of 70%. If you have a win rate of 70%, you see it's more than our minimum win rate to break even. In this case, you have a positive expectancy of $100. So this is a positive expectancy strategy. And remember, what tells us whether we have an edge using our trading approach in the market or not is having a positive expectancy. And what tells us that we don't have an unfair advantage over the market is when we have a negative expectancy. And so in this case, because we have a 70% win rate, even though we are risking 2 times what we're winning on average, it still doesn't really negatively affect us. We still end up making money. And that's because, we are above the win rate required to break even. But what if you were making $1,000 when you won a trade, but you were losing $5,000 when you lost a trade? In this case, you would need 83.3% just to break even, not even make money. No, just for you to break even. So in this case, let's say you have a win rate of like 85%. With an 85% win rate, you'd only have a positive expectancy of 100%, which is not bad. You're profitable, but still, just look at, somebody will look at your win rate and think you're making a killing. But let's flip the equation. Let's say your average win was $5,000 and your average loss was $1,000. In this case, look at the minimum win rate you need to break even. It's just 16.7. So if you had a win rate that was just 20%, just barely 20%, look, you'd still have a positive expectancy of $200, which is even more than that person that has a positive expectancy of plus $100 and has something like an 80% win rate. So you see, when you understand these numbers, it becomes evidently clear to see that trading is just a numbers game. It's not about having the highest win rate or the highest risk to reward ratio. It's a combination of all of these things. When you know these numbers beforehand, before you engage with the markets, then you can design a trading strategy that is going to give you an unfair advantage in the market with regards to this. Okay, so moving on. So basically, in a nutshell, what we need, the single number you need to know whether you have an edge that is going to make you money in the markets or you don't, is your expectancy. And not just expectancy, a positive or a negative expectancy. If you have a positive expectancy trading system, then that is telling you that the likelihood of you making money with that trading approach or trading methodology or trading strategy when you deploy it to the market is very, very high. And so you can actually trade with it live and it's going to compound very well over time. But if after testing, you discover that your expectancy, the expectancy of the trading strategy or approach you're using is negative, then there's a high likelihood that when you trade with it, it's going to end up losing you money over time. That's as simple as it gets. All of those things that traders will tell you that, okay, your strategy needs to have a win rate of like X%, you don't need it. Your strategy, just like I showed you, if your average win, for example, this is just simply you trading with a trading strategy that has a 1:5 risk to reward ratio. In this case, even if your trading strategy had a win rate of like 20%, you'd still end up making money. And the higher the win rate that the strategy has with these numbers, the more money you're going to end up making. So if your strategy had like a 40% win rate and it has a 1:5 risk to reward ratio, for example, just look at your expectancy is like $1,400 per trade. That's insane. Okay, and that's why most of the times you notice that trading strategies that have a high positive reward to risk ratio, okay, usually they have a low win rate. Usually it's going to be kind of difficult for you to find a trading strategy that has a 1:5 risk to reward ratio, for example, having a win rate that is like 40 or 50%. Because if that was the case, you would just be printing money at that point. Okay, and again, you could have a trading strategy that has a negative risk to reward ratio. I explained this to you. You might have a strategy that whenever you win, you're just winning, like maybe let's say $200. Okay, $200, but whenever you lose, you're losing like $1,000. Now in this case, with this type of trading strategy, you can see the minimum win rate you need to break even is around 83%, 83.3%. So in this case, for you to just be able to break even, okay, if you don't have a win rate of like 83.3%, you're not going to even break even. Meaning, break even here, what I mean by break even is you've not even made any money and you've not lost any money. For you to be able to make the slightest amount of money with this type of trading strategy, where you're risking, 1x, for example, to make 0.2, okay, you need to have a win rate of like 85%, for example, at least 83.3% to break even, and for you to make money, it's like 84%. So if your win rate was like 85%, and your average loss was $1,000 and your average profit was like $200, your expectancy is only $20. Just look, just $20. But on paper, when you tell somebody that my trading strategy is the best, it has a win rate of like 85%, it sounds great to hear on paper, especially to newbies, because for them, your win, the amount of times you win is much more important than anything else. Okay, but professional traders know that, all of that is just kind of like a facade. Is most of the times a professional trader is going to ask you straight up, what is your expectancy? Because that number is going to tell him everything he needs to know about your trading approach. If you have a positive expectancy system, you're profitable. If you have a negative expectancy system, you're not going to be profitable over time. And not just that, even if your expectancy is positive, how big is it? Okay, because just look, somebody with a trading strategy that has an 85% win rate on average, on paper that sounds awesome, and you have a positive expectancy, yes, but just compare it to somebody that has a let's say that is trading with a trading strategy that has a 1:5 risk to reward ratio, just like I told you earlier on, and his win rate is just 20%. Remember, the win rate required to break even is around 16.7%, as you can see here, and he has a win rate of 20%. With only a 20% win rate and a 1:5 risk to reward ratio, you can see that this guy has a expectancy which is far higher than the expectancy of the other guy who has an 85% win rate and a 20% expectancy. So this is just what the number does. Okay, even if you don't have a trading strategy, which comes back to what this whole class is about, when you are about to develop your own trading strategy, you can have an idea of what you are expecting by knowing how these numbers play out. For example, let's say you know that you want to build a positive expectancy trading strategy, and so you understand the numbers and you know that you cannot be right 100% of the time, and so you want to give your trading strategy a huge margin of error. So you say that, okay, you know what, I'm going to design a trading strategy that as bad as it gets, when I take 100 trades, at least I'm going to win 25% of those trades, and even if I lose 75%, I'm ready for that loss, I'm preparing for it. And so you design it in such a way that you are risking 1% of your trading account's capital in order to make 5 times what you're risking. Let's say you're trading with a $100,000 account, for example, it's a prop firm account. It's not hard to get capital in these days, as long as you have the skills. Okay, so let's say in this case, $1,000 is going to be 1% of your $100,000 starting account balance. So if you're risking that 1,000 to make 5 times what you're risking, your average win is going to be $5,000, and your average loss is going to be $1,000. Okay, now in this case, already, even without finding your technical indicators or your market structure or whichever method you're going to use to define when you're going to buy and when you're going to sell and whatever you're going to do, you already know that you want to have a trading strategy that has a positive risk to reward ratio of 1:5, for example. Now in this case, from the numbers, you know that before you are expected to gauge the performance of a trading strategy, you need to take a large sample of trades, and in this case we're preparing for like 100 trades. Now before we do anything else, you know that the minimum win rate you need just to break even is around 16%. So if you're able to make that 25%, your trading strategy to have that 25% win rate, you're going to have a very, very positive expectancy trading strategy, which is like $500 per trade. Now in this case, this is a beautiful trading strategy because you are factoring in the probability of you losing even much more times than you win, and still being able to end up making profits in that case. And so knowing these numbers and then going on to design a trading strategy that will give you, so that whenever you take a trade, you're risking 1 to make 5, and you are preparing to lose like 75% of the time, and after taking 100 trades, even if you only won 20 or 25% of the time, you'd still end up making a very healthy amount of profits. This is how you build an edge. This is how you build an edge. It's not rocket science. It's all just numbers, okay? So you don't need to master any SMC technique or any super complicated thing that you can't even explain to traders in simple language. Not trading is just a numbers game. That's just what I'm trying to get at the end of the day. Okay, so this pretty much brings us to the end of this week's edition of the class. But as usual, before we wrap up the class, I'd like to use this opportunity to invite you guys to test out our suite of ITU bots, which are designed to trade on your behalf, to look for low risk, high probability trading opportunities for you, and then place those trades for you and get you earning while you're learning how to trade properly. Okay, so if you're interested, please reach out to us on any one of our social handles, or just drop a comment or a comment in the comment section, and we'll be more than happy to assist you set everything up step by step. Once again, thank you for taking time out of your busy schedule and coming to this class. I look forward to seeing you guys in next week's episode. Have a wonderful rest of your week, and God bless you all. Cheers.